All right, good afternoon, everyone. My name is Blair Nickel, and we also have Charlie McGee. Both of us are with FranNet here in the Pacific Northwest. Charlie mainly works with clients in the greater Washington State area. I mainly work with clients in the Oregon, Idaho, and I'll throw in a little bit of Alaska there too. Today is a conversation, is an open conversation from Charlie and I to kind of share with you what we learned at our national meeting. So we started doing this a couple years ago, just as kind of one of those, hey, I got an idea. Why don't we just, we each come back from our national meetings and why don't we just kind of share our learnings from that national meeting? I'm sure people would love to hear about it because it's nothing secret that happens at our national meetings, but we do learn quite a bit.
We used to have our debrief at the bar. We
right.
and that was always, sometimes when the best ideas or observations were exchanged, and we thought, you know what, I've got people I'm working with right now, clients. I know they'd be interested in these insights. So yeah, I think it's been kind of fun to take it, do it in this format. So yeah, great to see you, Blair.
Yeah, you bet. So we will stop it at 12:30. So we want to be respectful of your time. And if you got questions or, hey, was this topic covered at our meeting? Just put it in the chat box. I'll watch the chat box and we'll make sure it gets answered. So the way our meeting is structured is how many franchisors were there? Over 100 different
125 or something. Yeah, it was a bunch.
Over 125 different franchisors. Charlie and I met with probably somewhere around 70 some odd of that 125 individually, and as well as support companies like finance companies. So we're going to share with you kind of what the trends that we saw happening, the trends that we see happening within franchising, as well as a little bit of financing, kind of a latest, greatest within financing. And then, like I said, if you got any questions, we'll make sure that those get answered. So Charlie, you want to kick us off on kind of what you saw as kind of the trends?
Well, I'll tell you what, why don't we get funding out of the way?
Okay, sure.
That's a top of mind question for a lot of people, and they can hear, if they're listening to a recording of this, they can listen to that and then know that they're done. So here's what I got from it, and that is the ROBS program, the rollover for business startup, is probably 50% of the book of business for the funding companies. It's a split between the ROBS and the SBA 7A loan program, which has been around forever. The people that are doing ROBS, the motivation is they're avoiding the higher interest rates and cost of debt that people are experiencing now, relative to where it's been. So there's sort of a psychological thing there, but it's also, it's not a loan, it's your diversified investment.
Can you go over, there's probably some people on here, Charlie, don't know what ROBS is.
So ROBS, ROBS, rollover for business startup, is where you can take a qualified retirement plan or IRA from a past employer, not a current employer, and use a portion of it, or as much as you want, to invest in your own business, including a franchise. So, in your portfolio, you're gonna have some mutual funds, you might have stock funds, REITs, whatever. And a business might be particularly your own business, could be a smart way to diversify that portfolio. And so we work with a couple of different groups, a few different groups that are experts in this field. It's been around for decades, it's nothing new. And if you want to find out more about that, reach out to Blair or I, and we'd be happy to do that. When you think about like the market last year, I mean, stocks were bad, bonds were bad. My portfolio got hit, I think most of ours did. And it would have been a good year to have a diversification with your own business, particularly if it was an essential services business, which is what has been doing so well in the post-COVID era. And so anyway, I don't want to spend the whole time talking about ROBS, but it is going strong. The SBA program is also, continuing to be dominant, prominent in people's funding strategies. The 7A loan, the SBA guarantees the loan for a local bank which enables a local bank to lend, or I say a local bank, it could be a bank anywhere in the country, but to do this lending. They set their rates based on the Wall Street Journal prime plus 2 to 2.75 points. So right now, today, the prime is 8%. And so or is it 8.5? It's the 7A loan right now is 10.75. The banks are looking for a 20% cash injection. A franchise fee often, meets that part of the requirement. You need to have some money left over after you've paid the franchise fee they want to see that to help operate the business. You need to have an additional income stream into your household, like a spouse's job, for instance, in order to qualify for that particular loan program. What else? You can get a pre-approval at no cost and no obligation. It's a good way to kind of start thinking about what the appropriate budget is going to be for your business. If you are pre-approved and you opt into one of the service providers programs like FranFund, for instance, which does excellent work, charges $2,500 for their they will help you package your loan and with a red bow, and they have a 99% success rate of people getting approved for those 7A loans with the pre-approval letter. So
they'll even write your business plan for you too. They have business plan writers that'll do everything. So like Charlie said, wrap it up in a red bow. They literally do.
Yeah.
I think what I took away from it, Charlie, is that the banks are more eager to do small business loans right now because quite frankly, they're making more money off of them right now. Now, having said that, have interest rates gone up and therefore making the business loans more expensive for you, the business purchaser? Yes, that is correct. Hence, while we're still seeing the vast majority of our clients use the ROBS program, because it's still one of the fastest, cheapest, that's not even a word, cheapest option to fund a business.
And, keep in mind, it's a variable rate. So, if interest rates come down, the rate's going to come down. And if it goes up, it's going to go up. It's worth noting, if you had a $200,000 loan and it changed by a full percentage point, it's only going to make $100 difference in your payment. So most businesses are going to be able to absorb that kind of variance. And if you can't, then you probably overextended and you're over leveraged.
There was a question, Charlie, that just came through from Alex. And the question was, can you withdraw a smaller amount from the approved amount of the loan as needed? Or do you have to take the full value of the loan in a single instance? I think now I did hear of another product out there, Alex. How was it described? It was described basically as called a micro loan. It was almost like this came from Benetrends. It was basically a credit card with a limit of $100,000 on it. And you can use whatever amount of that amount that you want. I can't remember the terms of it, but
there are a variety of lines of credit that you can get, Alex, and that may be in the context of your question, it might be more appropriate. People are still using HELOCs, and that's been a popular option too over the last few years. People have a lot of equity in their homes. Even with a little bit of cooling of the real estate market, you still have a lot of that credit. So, and those are fast and easy and cheap to get. So sometimes that makes more sense. But Sonia, if you want to know more, have a more detailed question about funding, thinking about maybe what what size business you should be thinking about, reach out to Blair or I. Moving on to the conference itself, I noticed, I've been with FranNet for 10 years, Blair 20, Blair's been there for almost 30 years.
26. Somebody thought I was kidding too. They're like, there's no way you've been around for 26 years in FranNet. No, it's true. I've been around for 26 years.
That's what you call your marathon anniversary, 26. Yep. So we have both been to a bunch of these over the years. We have 2 a year. I'd like to kind of look and compare and say, well, like who should, what's the difference in the roster of franchisors that are attending and participating, this time versus last time? It's fair to say the last 36 months or more have been pretty volatile, with COVID and coming out of COVID and then inflation and, the Fed trying to cool things off. And are we heading to a recession and so forth? But I'll tell you what, despite all of that volatility, there's I describe it, Blair, kind of a foot on the gas mentality among the franchisors, most of whom we work with are need-based essential businesses, and which is kind of, I don't know, it's not always like the sexiest thing, but it's tried and true and pretty reliable. And yeah, sure, there's always a few concepts in there too which address people's wants, but I counted 33 new presenting franchisors at the conference, and from a variety of spaces. I mean, the pet space is blown up. There's this cool mobile dog training concept. There was a really impressive new chiropractic multi-unit option. The garage space has got a lot of players in it. I mentioned before we had a new hair care space. Child enrichment is huge. Kids have had a hard time with anxiety and so forth coming out of COVID, and people are looking for all kinds of ways to give their kids more support, particularly in the area of sports, which we could talk more about. There were 7. Well, let me stop there. Blair, in terms of new concepts that you saw coming at the conference, what were your observations?
It wasn't really new concepts, Charlie. I think it was more categories, if you will. The categories that, yes, they've been doing great over the past few years. Everybody, the consensus at the meeting is we think they're going to do, none of us has a crystal ball, but hey, as far as everything people can tell, these categories we're going to do really well. I'll put one big umbrella, and that is essential services, right? I would include within essential services, like you said, pet related businesses. I mean, those have, like you said, have just gone ballistic. Believe it or not, fitness and health. Now, you would have thought fitness and health would have been quite a bit affected. No, it's gone the exact opposite way. It's done really, really well. Semi-absentee is still a very, very big category. Elderly care, or assisted living, senior care services. And overall kind of low cost service based or low cost B2B categories, everybody expects to do well over the next handful of years.
And I think with something like low cost B2B, the franchisors haven't changed who their ideal candidate is in those spaces. It's somebody that really is a business development professional, somebody with some background in sales that's ready to be their own boss, is tired of moving goalposts and quotas, and really loves to network and understands how the digital age has changed prospecting and so forth.
That was actually very interesting, Charlie, that a number of franchisors brought up, including ourselves as a company, and that was how are companies changing with artificial intelligence. That was a big one. We're probably all hearing about ChatGPT. A lot of companies are integrating that as part of the customer experience, and that's just something that's, as far as I know, I'm no techie, something that's kind of really gone up over the past couple months, really. Yeah, so they're all watching that very, very closely for the positive side to, like I said, really improve the end user customer experience.
Yeah, the ground is definitely shifting under our feet in that regard. The world is rapidly shifting, and the franchisors that have invested the resources to build really strong infrastructure, particularly when it comes to having their own digital marketing group, which directly supports, in some cases, manages, implements, and executes the digital marketing programs on behalf of the franchisees.
Yep.
So that they can focus on, scaling their business. They have their own calls. Increasingly, I see more and more franchisors having invested in their own call centers, which is, placing warm lead appointments on the franchisor's calendar for their sales team to go and implement and execute. And the smarter all that automation and the smoother it is, to your point earlier, Blair, about, executive models where the owner is less involved in the minutia of the operational details day to day, it's giving them a little more flexibility. I thought it was interesting that a couple of our, blue chip, like franchisors that have been with us for 15 years plus, who have never had a semi-absentee business model offering, now have that. And this is true in staffing, it's true in window cleaning, and a whole range of others. So I think some of it's a response to customer demand. Everybody during COVID got a little taste of more flexibility and autonomy with their time, and want to have a few different things going. And if you're working virtually, you have more flexibility than you used to, and you have the bandwidth to do it. And that's what people are looking for. I'd say 2 out of 3 clients I talk with are looking for some kind of vehicle where they can gain more flexibility with their time.
Yep. And so that is true, Charlie. I heard that time and time again of, like you said, oldies but goodies, or, hey, the good business models, but they were mainly a full-time business model, where the demand from a lot of potential franchisees is semi-absentee. And so a lot of times when these companies come to us and we learn more about them, and we're able to ask questions of them too, when they say they now have a semi-absentee option, our next question is, well, do you have franchisees that are actually doing it?
Right.
Right. So is it validating?
Yeah, let's and I mean, that's worth pointing out too. I think for you and I and experienced advisors are always going to point or are going to demand of the franchisors more detail about validation. It's a fast growing category and segment. We see new players come in all the time, young, micro emerging franchisors. In other words, they may have, 2 locations open, or maybe they have their original corporate unit, and now they think that they're poised for national growth. And, again, we're talking about like, who's at this conference this time, who was at the conference last time. Sometimes, they're not quite ready for prime time. And, I think when Blair, when you and I are helping clients build their ideal business model and think about, okay, what are the kind of must-haves and what's going to be important to consider in coming up with the right matches, their risk tolerance is one of the things that has to be considered. And if they have a high risk tolerance and there's a really desire to be, first to market, then, those micro emerging brands might make sense. What I always look for is I like to kind of cheat and say, well, maybe it's not micro emerging. It's done well on the East Coast, or it's done well in the South. They haven't come to the West Coast, or maybe they just haven't come to Washington. And if I can, jump on that bandwagon for the launch in Washington when there's still lots of white space and there's lots of good territory available, And the client doesn't have to bear so much risk, of a brand new, untested, unproven model. Well, to me, that's the best of all worlds. And I'm glad to, I always discover one or two little hidden gems at the conference, and I've got a couple up my sleeve. So that's going to be fun.
I think one of the things that really helps, Charlie, and I think, we all are seeing more and more of it, as far as, a major trend that's happening within franchising, and that's consolidation. Meaning that, hey, it can be a micro franchisor, but they're part of a larger umbrella company, like premium service brands, Neighborly, Buzz brands. There's all kinds of them. And so they kind of reap the benefits of being a sister company to many other franchises under the same umbrella. So we're seeing that more and more and more.
Yeah, platform franchisors.
Yep.
I think, and if we went back and listened to our previous conversations from the last couple of years, I'm sure that I know that we've talked about it, and you're absolutely right. That trend continues. And now that those platform franchisors are set up, they are adding to their own and diversifying their own portfolios. And I can think of several founder-driven, independently, private companies, franchisors that have been absorbed by, or say absorbed, they've been acquired, which, is that a good thing or a bad thing for existing franchisees? I think sometimes people fear that it means the fees are going to go up. But I would say more often than not, the value proposition for new franchisees and existing franchisees becomes more robust. It's
sure they're able to market with each other. And that's kind of what the acquirer is hoping, is that they can help market the services of one sister franchise with 5 or 6 or 10 other brands that they have, and vice versa.
Absolutely, it lowers their customer acquisition costs.
Right.
And the other kind of cool thing, I'm working with a client right now who's I would say a visionary, and he wants to own multiple service concepts within a particular geography. The franchisors are referring to this as stacking, and when you can do that within the same platform franchisor brand, within the same ecosystem, so that all the customer data is appropriately shared, then there's some new levels of efficiency that a local executive style multi-brand franchisee can experience. That's going to be a fun trend to watch over the next couple of years.
Yep. So we got about 5 minutes left. If you got questions, or if there's a topic you're wondering if it was covered at our meeting, feel free to put it into the chat or question box, and we'll watch it here. The other thing Charlie and I will do here in another minute or two is put in our own contact information. So if you got follow-up questions or just want to have a one-on-one conversation, we'll be able to do that. In fact, I'll put mine in right now, Charlie, and then you can do yours. And I'll watch the chat box here.
So some of the other, I mentioned we had like some concepts that were back again, that might have taken a pause in the fall, from lab testing, youth enrichment, beauty services, home inspection, massage. Some of the categories that were not there, kitchen remodel. The remodeling business just blew up during COVID, didn't it? And I'm reading a little bit that there's some people scratching their head a little bit about, if a recession is here or is coming, what's that going to do to remodeling? So we'll have to keep our eye on that.
There was a question that came through, Charlie, and if you want to put in your contact information, I'll read out the question and get it answered. Dean asks, acquisitions don't always work well for various reasons, even when there are synergies. What tools are available for evaluation, or how long do you have to watch for success? That's a great in-depth question, Dean. So generally what we'll look for is if the parent, called the parent umbrella company, have they done acquisitions before, and what's happened with the acquired franchises within that umbrella company? In other words, did they trend up? Did their sales go up? Were there synergies that worked really well? Or, hey, it didn't work well, and that's a red flag, and therefore, hey, maybe that franchisor is, still learning, and they need to iron that stuff out before doing any more acquisitions. So that's one thing that we look for, is if it's a umbrella company, is have they done it, and have they done it successfully? And usually we want to see, I don't know, a year or two worth of validation, if you will, to see if they've done it well.
I'll throw in another thing that I heard more of this time, Blair, and maybe you did too, but there is, in addition to my work with FranNet, I'm also involved with a IBA, a 50-year-old business brokerage in the Northwest that just deals with existing businesses. And often people will say, look, I'd rather have a business with some existing revenue rather than starting from scratch. And there are franchisors now that have developed over time kind of an M&A process where they will target existing businesses in their category and with a conversion model where that business is acquired, it's converted to the franchisor's brand. All of the strength and ingenuity and systems and processes and technology that franchisor offers then is kind of built into and layered into that existing business. But somebody says, hey, look, I really want something with $150,000 in free cash flow to start. I'm willing to pay for it. That a business like that might have a multiple of 3x. But I like the idea of a franchise system, of a proven model. I don't want to just be, on my own. That's a sort of a newer category or group of options that candidates have. So if you're interested in learning more about that, let Blair or I know.
Sure. All right, we are at the half-hour mark, so want to thank everybody. Hopefully that was helpful for you. Charlie and I will do this again in the fall after our next national meeting. I think we're in Cincinnati, if I remember correctly. It was actually kind of nice to get down to Phoenix last week and enjoy a little desert weather. But anyways, hope you enjoyed it. We will get the recording out to everybody. Again, if you just have general questions in regards to franchise ownership, or obviously if you're already a client of ours, we'll continue to be in contact with you. But on behalf of Charlie and I, thank you, everybody. We really appreciate it.
Thanks, Blair. Nice as always.
Yep, you bet.
Take care, man.